What's up traders, Tom here with another video. Everybody sometime in their trading or investing careers will come across something that sounds amazing, irresistible, and possibly the bargain of the century. The question is, how do you know if it's really a bargain or a trap that will cost you your hard-earned money? Stay tuned. Before we get started, I'd just like to remind everybody that if you're enjoying our content, make sure to hit subscribe and the alarm button to receive more of our videos in your inbox. And of course, remember to join our Telegram community at the links below and get involved in trading the markets. So we'll begin the video talking about oil. And oil is currently in a semi-miraculous recovery from previous lows in terms of where it has been over the last 2 months during this crisis. So oil has become synonymous with the negative contract, or the day where basically oil went negative $38 a barrel before expiry. And it's the expiry component that we are going to be talking about today, because any oil trader, any trader that's looking at buying any commodities or looking at trading synthetics in general or anything like that needs to continue watching this video to see why some of these moves are a fool's game long term when it comes to trading these pairs. So oil is up. Oil has made a miraculous recovery. Let's look at the actual charts in a minute. Second thing I want to bring up, and this just comes to our overlying story on this channel, which is that many people believe that the current crisis is over and we're now moving into opening economies and things are looking great and everyone's happy. And I go down to the local park here in Australia and there's 170 people standing on an oval, all supposedly social distancing and things like that. But let's face it, there's a high chance that something will happen again. I've mentioned the second wave on this channel, and it looks like potentially China's new outbreaks could show signs that the virus could be changing or mutating. And we have seen this before. This is the nature of this type of virus. So if this is true and the second contagions are actually more, let's call it deadly or more infectious, then that could be another problem for stock markets and for commodities and for other indices around the world, that we are in for a second downturn. And that's something that will be evolving. And so the reason I really want to talk about this is because, look, I've been burnt by this before for thousands of dollars, absolutely thousands of dollars. And once you learn something like this, you never want to do it again. But you know that this has hurt tens of thousands, hundreds of thousands of people around the world who have thought something and it has not been true. The bargain of the century has turned out to be the nightmare of the century. I recently heard about a gentleman in, I think it was Interactive Brokers, and he was trading oil contracts when they went negative, and his account literally went from something like $100,000 to owing $1 million+ in terms of money. So it just shows you that this trap can hit anybody, and that is why it is so important to talk about it in today's video, and more importantly, talk about all the different markets that it can happen in and how to spot it before it happens. And I think that is going to be through exchange traded funds and looking at their results over the longer term. So here we have US oil, and I actually want to bring up USO or USO. And this seems to be the actual synthetic exchange traded fund that so many people like to trade. Now, we'll go back to US oil just quickly and we'll see a miraculous recovery in terms of where oil went and where oil is now. And notice this massive spike down and then spike up to around $14 and then continuation to where we are now, which is about $32. So I know what you're thinking. You're probably thinking that if I bought it here, don't I just profit off it going back up here? The biggest problem with this is actually that this is the difference between the contract expiring and being delivered and actually somebody having to deal with the oil issue, which is of course the tankers, and the new contract opening. So the new contract opens the next day and actually you're getting more of a price somewhere in this zone. Now, was there money to be made? Yeah, there is money to be made here, but it's not where the smart money is made. It is absolutely the short and sharp, in and out, scalping, and that's all it is. If you're holding contracts to expiry and letting them roll or rolling them, or you've never done this before and that's something you were considering, you need to think twice before doing this, because this is how, of course, the system makes money, and this is why they offer these things. But buying oil at $0 or buying oil at $12 and holding it long term is not going to be the way that you are going to make money. There are other methods which we'll talk about. Now, if we zoom this chart out and we actually scroll back in time, we can see where oil has been over the last years. And it looks like, well, it's a no-brainer. If I can buy oil at $0 or buy oil at $10 or buy oil at $14 and hold it long term, we will eventually return back to 60s, 70s, maybe even $100 one day, at least 40s. It all makes sense. Yeah, if you hold it for a few years, it will get back there. That's the general consensus. The problem is when the reality bites. So this is what you think you're getting. So you think you buy it down here, and you think you hold it to $32 and you've made a miraculous recovery and tons of money. But USO or USO holds the different story. So this is an exchange traded fund of oil. Now, if we zoom this one out, now if we take a look at this, this is the recovery we've seen in this particular exchange traded fund. I'm going to zoom right in on it. So we've gone from around $17 to around $24. Now that is a massive difference to the other chart, and technically this is tracking the other chart, and I'll put that in inverted commas, tracking the other chart. So when we zoom it out, we start to see a very disturbing story, and this is what happens with synthetic trackers. So notice the GFC over here on the left hand side. Basically, 2008 into 2009, oil took a tumble. Oil went from a lot per barrel down to, of course, a lot less. Now, during that period of time, the value of this exchange traded fund went down significantly. So it started at around $940, and then it went down to around $200, and then had a recovery, which percentage-wise was quite large, stayed in a range, and then during the 2016 oil kind of crisis, it fell off further, recovered, stayed in a range. So we see two similarities here. One, when it fell the first time, it stayed in a range after that and never even got close to recovering. The second time, when we saw a large dip in oil very quickly, it fell, stayed in a range, and never fully recovered. Now, this is what brings up the point of maybe the best, worst kept secret in terms of synthetics and in terms of seeing actually visually how bad these contracts are over the long term for you as an investor. They do not recover. They do not recover because of a few reasons. One of those reasons is contango. So contango, also sometimes called forwardation. It's a situation where the futures price or the forward price of a commodity is higher than the spot price of the contract today. So effectively we have, let's say, something that's tracking the index or tracking the so-called commodity, and that price is different to the futures price. So we have absolutely seen that in oil. If you looked at, let's say, the famous contract that went negative $38, basically the reason that went negative $38 is we have a problem with delivery. No one wanted to take the oil, so no one had any availability. Everything was full, every tanker was full. It was effectively impossible to trade that contract off, and it actually was costing you to get rid of it. So if that contract expires, what do we think's happening in the later dated options? What do we think's happening in the later dated contracts? Well, of course, if we went and looked ahead to Christmas, the actual forward contract was trading at a significant premium over the current contracts. So whenever you see something like XTI US dollar, XBR US dollar, or some other synthetic, or an exchange traded fund that trades a synthetic, they will have a contango effect where effectively the market will swap every time that forward contract needs to be sold and rebought, and you will be worse off. Now, I can tell you that with this particular fund, the O fund here in Australia, this particular fund was paying 25% contango cost. So that means every month you needed oil to recover 25% if you were to make your money back. I'll let that just sink in. You need 25% per month. And this is because the VIX index for this particular commodity was incredibly high. It was about 300% plus. It's never been that high during the crash. So you were paying 25% contango. Every month you're basically losing 25%, and you need this trade to make more than 25% for you to make any extra money. And that does not sound like the kind of thing I want to do. So it brings me to my next point. And my next point is, well, how do we trade oil then? How do we trade these things? How do we trade potentially gold? Do we have to buy bullion physically? Well, with gold, I think the best way to do it is potentially an exchange traded fund, but you look to exchange traded funds that literally are bullion stored in a bank that you pay a management fee to be holding, and it allows you to get in and out of it. Now, many people in my bullion video mentioned this week that the buy-sell spread on bullion, if you were to go physically give it to somebody, could be 10 or 20%. That's ridiculous. I mean, you were never going to make any money unless you hold it for a very, very long period of time. So that's why the stock market's so good. It's so efficient. The property market, you've got to pay decent brokerage spreads. I mean, when you pay your agent, you have to pay them potentially 1%, maybe 2%, maybe 0.5%. I don't know what country you're in and what it costs, but usually 1% to 2% for sure to sell your property. And I know the more expensive properties, they can lead up to 5% commission just to sell the property because they're very difficult to find specific buyers for. So everything comes down to, if you're going to hold a position, when I'm getting in and out of it, how much does it cost me as well? This is ExxonMobil. So Exxon basically, you can see, has had a massive fall off with a decent recovery. And this is basically like owning oil from the stock side. So if we have a look at the charts here, look at the 2016 crash in oil. Now, up to a point, this particular stock will actually mimic the crash and give you a similar opportunity. Then when the opportunity becomes too good and irresistible and you want to get in, would I rather buy USO or O or some form of CFD that has a forward expiring contract? Or would I rather buy the actual oil producers, so the actual companies that have the assets? Well, I think the clear case is these companies. Now, I'm not saying Exxon is necessarily the one you pick, because there are other smaller tier ones where you'll make more percentage, but it does generally recover over time. So the GFC, what happened? Then it recovered and actually ended up making a new high. Now, this company's had its own other fair share of issues, but it came down and then pretty much recovered here. And they're good percentages. Now, again, it's come down to effectively prices that were not seen since 2003 over here, and it's starting to recover. Notice the recovery isn't that extreme. We're not at the point yet where these companies are out of their problems, but you will eventually see this particular stock go up over time. It's a good way of getting involved in that commodity without owning the actual commodity purely, because that is really the fool's game. That is where you're paying amazing amounts of money. Woodside, that's a company in Australia. This is a petroleum company. Very similar story. 2015 into 2016, crash in oil, recovered somewhat. The crash from the GFC recovered somewhat. So there is opportunity here for longer holding. And we can see that oil has not been a very beneficial long-term hold, but it still provides opportunity to get in. And it is the better choice when it comes to trading, at least for a multiple month hold. I like to buy a spread of all of them. So I might buy 10 or 20 different companies that are all massive, that are involved in oil. And that is how I would get access to the oil market. I'm not going to do it through the other methods. And I think you can probably see why. I had a question from a viewer the other day, and they were actually talking about, hey, I want to buy the VIX. It's a no-brainer, yeah? So when you look at the VIX and you're looking at it over time, I would always just buy it here. Let's buy it at 10. Let's buy it at 12. It looks awesome. I mean, every time you buy it here, it spikes, you close it, that's it. So this is the ultimate market where you can see the absolute effects of contracts expiring and coming back. I say it in soft commodities. Soft commodities are incredibly hard to trade. Wheat, orange juice, all these types of things. Very, very difficult. You need to be aware of the instrument you're trading. If we look at something like this particular exchange traded fund, which trades the VIX, look at the significant costs over time. So look where it starts over here during 2011 and the degradation of your money over time due to the forward contracts expiring. It's absolutely amazing. Look at that. Terrible. So if you're ever looking at an investment, and let's say I'm looking at it over here and I'm only looking at 2 years worth of data, you better make sure that you're looking at the entire picture over time, because eventually this fund is going to have to be restarted. So this fund will eventually run out of money effectively and be restarted or reset. And that is the key to when you're trading this particular stuff. You need to know your instrument. Synthetics ultimately are a fool's game if you're going to hold them long term. Look at the alternatives, look at the stocks, look at the companies that hold these things. Buy 10 or 20 of them if you want to, but look at doing it that way rather than the synthetic if you're looking for the long-term hold. So hopefully this helps everybody today. And of course, if you're enjoying our videos, make sure to subscribe, hit that alarm, and of course, comment down below and like the video. Happy trading, everybody, and we'll see you in the next video.